Hey guys, Mike here. So I'm back and I appreciate all you guys wishing us well on the trip, and it felt good to get away because sometimes you're right. You just got to get away, decompress, and disconnect from everything. So it felt good, plenty of sun, lots of fun with the family and friends. So appreciate that, guys. But now I'm back. And, we got a lot to get into, a lot to catch up on and stuff. And so we're going to get into the charts, the banking, what's going on now with this banking industry. Going to get into, what is big money doing? Because, boy, they seem to always be able to time it right. It's like they got insider knowledge or something. I tell you, it's always amazing to see. And then we'll get into a few other things. But if you just look right here, I mentioned this the other day about the discount window. This is where banks borrow from, normally taking a haircut, but they lowered the rate to make it easier. And I want you to look at that right there. Straight up. Bam. Look how much higher that is even than 08, which was a banking crisis, for crying out loud, right? I mean, just look at that right there. And the top chart to watch this week, or a lot of people are going to watch, is the XLF, right? And this is the weekly. But you can see it goes all the way back to 08. And if we just kind of zoom in here, you can see this level we're at going across. It is a critical level. You can see it's coming down into support. What was support right there? You can see resistance back there, resistance, going all the way back, and you can see resistance right there. And then we'll shoot back to 08, and it was resistance. So can it hold the support level is the key. Like how many people are shorting these stocks is what you're going to have to see. Because you can see a big drop if that happens, obviously. That is a major support level. And of course, they're pulling out all the stops, and some people think they can pull out as much, put like $2 trillion into the banking system to try to back by actual deposits and things, right? And just look at this right here. This is the Fed funds balance sheet. What a joke. They ran $600 billion off, roughly, right? In 1 week, they added back $300 billion. Half of what they took, basically, a year. Exactly a year to run off. They put half of it back on there in 7 days. And, let's look at that right there. I mean, that's a mess. They're never going to be able to run this off, And this right here is Warren Buffett. Not really, but I'm sure this was him last week because he got a call from the government talking about this banking crisis because he knows a lot about it and stuff. And I'm sure he's putting money to work. I'd be surprised if he's not. If not, he's going to be the vulture waiting in the wings, right? But a lot of people did put money to work, and the SPY ordered $7.3 billion into this ETF after the bank rescues. And we always talk smart money and dumb money, guys, and I'm telling you, they time it perfectly every time. Look what happened when the S&P fell. I already showed you what were we doing. We were already selling out. Boom, sold out big time. And what was and this is big. I think they call it, smart money or whatever you want to call it. But this is big purchases taking place, right? Well, they're buying it. They were buying it up, right, on the way down. And so they're making a killing on that part of it. And I don't know if they did it because obviously they already knew the bank rescues were in place. That's why they did it. And bloods are in the streets. Or they just knew, well, seasonality-wise, coming up is April. So we need to get in now because it's the highest rated month seasonality-wise of any month when it comes to the S&P. And if you get anything out of this, guys, please hit that like and subscribe button. I really appreciate it. And if you're new, think about subscribing. If you like this content, I really appreciate your support. Now, of course, is that guaranteed to happen? Of course not. I mean, we got a lot of stuff going on, right? But still, 80%, I mean, that's pretty good odds at least if you're going to make a bet or whatever, you want to be in there. And especially when the Fed has come out and said, look, we're backstopping the deposits, right? And the reason why they really have to do that, as one of our members shared in the Discord there, was because small and mid-sized banks make up like 50% or more of all lending, right? Whether it's commercial lending, real estate, you name it. And so that's why you can't let a run, because what's going to happen if they don't back it, there's going to be just all these runs on the banks, which will happen to these banks. They're not going to be able to hold up, right? They're just not going to be able to hold up. And because most of these banks, what they do, they went out and bought treasuries and things. Of course, treasuries have been getting just decimated. And then when word gets out, they're selling at losses, they're setting at big losses, and people start panicking. And I told you, the media really wants to flame that whole scenario. And say, run on the banks, right? Because it makes good TV or whatever. And so for them to say, $250K, forget about it, we'll just back them all. And I get why they had to do it and stuff. And supposedly we're not paying for it, but really we pay for this mess that gets created in the banking system, especially people who are close to retirement or in retirement, because a lot of 401ks, a lot of RRAs, pension funds, hold bank stocks, right? And some of those stocks are down like 50%. That's a big haircut, all right? Especially if you need the money right now. It's kind of, you don't know all this uncertainty of where it's going to go. We'll have to see on that. Now, The next thing I'm gonna do before I get into the charts is, I always bring, anytime this gentleman who runs a volatility index comes out, I like to put it out there because he literally works up there on Wall Street and stuff. And he's talking about specifically what he thinks the Fed's gonna do coming up this week, why they're gonna do it, and what they're really trying to do. If you don't understand what kind of battle they're up against, like I said, it's not an easy game they're trying to play right now. And this whole banking crisis, if you want to call it that, really is kind of making things a little bit more hairy, because what happened last week? All of a sudden crypto, and again, here we go with the high beta stuff, just goes to the moon, because what are they thinking? There's gonna be a pause again. Remember I talked about that? Every time they think there's gonna be a pause, to the moon, Alice, right? For those who used to watch The Honeymooners, or if you're old enough to remember that show. But just listen to him real quick. It's about a minute, and then we're gonna get into the charts and stuff.
It's frustrating for the Fed, right? The Fed came out, and this was actually, in my opinion, very well telegraphed. They were out there selling calls. We talked about it, not literally selling calls, out there trying to get the equity market down, to get speculation out of the market, right? This is, I think this was all relatively telegraphed. If you look at the banks that went under, crypto and tech, right? That's what we're looking at. That's where the speculation has been. That's what they want out of the market. So in my opinion, this is something that the Fed actually wanted to an extent from the equity market. The problem is there's
clearing out the froth still.
Clearing out the
We've
froth.
We've done tech, consumer, why not banks?
Trying to use the wealth effect, right, to bring down economic growth. The market rallied 20% off the bottom. And we keep getting hot inflation numbers and keep getting, more and more speculation. That's exactly what they don't want, right? Mm-hmm. Now the problem is, as they do that, and they've been looking to pause. By the way, why do they want to pause? Because there's a lack of clarity at this point. It's been 5%, 4.75% move in interest rates, with very little pause, and we just don't know. There's a lag. We just don't know what's going on yet. So they've wanted to pause. The problem is the word pause is read as pivot. It leads to a 20% rally in market, which makes things hotter. And it's a really tough situation, right? So the Fed has been selling calls, trying to dampen the upside, remove the speculation. It's worked, right? And they've done that by talking yields, up. The problem is, now that we're getting this liquidation in the short term, we've seen an overreaction by the bond market, dramatic reaction, and the Fed does not want the long end of the curve coming down like it has. So expect that now. The headwind is actually, in my opinion, not this bank story that you're hearing about. This is not 2008. There's always a tail in banks, as you mentioned. That exists. You can't get rid of that. But the real story is that rates have to go higher. Yields have to go higher at the end of the curve, the back of the curve, while equities go down. And that's a hard combination.
This week, will they surprise next week?
I do. I think. It's going to be a quarter. I don't think they're going to come in and try and shook the boat, but I think Powell's going to try and talk up the yields in the back end of the curve. This is not what they want. They do not want the long end of the curve coming down and stimulating. I mean, just today we had housing starts come in super hot. Yeah, 24% year over year in multifamily investment. I mean, what do you think happens now that the yields along the curve have come down by as much as they have?
Mortgage caps are going to boom next week,
exactly.
Right?
So this is not what the Fed wants, right? From an inflationary perspective, it's not a problem. But they do want the equity market down, the froth out. So they got that part. Now they got to try and thread the needle again and raise kind of yields in the back end of the curve. So I would expect some of that. I think that's the next headwind that faces the market. The Fed is still selling calls that, don't fight the Fed. The Fed sold puts for forever, right? In the short term you may win, but in the long end you're going to get bled out.
And now that March OPEX is finished, now we get to see, well, where are we going to go, right? So because that was a quarterly OPEX, it just happened on Friday. So now we get to go ahead and say, okay, where's the market going to go? Because now all those puts have been flushed out and the calls are done. Now we get to kind of start over here and see what's going to happen. And a few things to look at on the SPY. When you look at what the options market is pricing in, the range is 378 to 402, right? And I think that 402 might be a little bit lower than what some people were thinking, And then when you look at this, you're going to have your anchor VWAPs from the October low coming up. You're going to have the anchor VWAPs from February. And so coming up, we'll see, how the market reacts coming up to those. There's a trend line right there that the bulls do not want to drop us below. That's the one we were in all last year, of course. You got your 618, and really your golden pocket sitting around 398-ish. And so we're going to have to see if we end up hitting a reversal there or keep piling on through it and maybe hit 402. Again, that range, 68% of the time, normally almost 70% we end up in that range. But there's a lot of volatility, right? And so, looking at the cues, you got your golden cross last week. You got them busting out of this chop box again, which it keeps coming back down to. But, it seems to be powering up. And so we're going to see, and plus you have that trend line right there that goes way back that is seen and been support and resistance multiple times. And so we're going to have to see, is it still going to be a risk on or not? And this is the stock right here, Apple. Watch Apple again. Huge weight, right? So, when you look at this, looks like an inverse head and shoulders, right? I mean, neckline's up there, but that's been a huge resistance area right there around the 155-ish area. And so, we're going to see it is an inverse head and shoulders carry out, but it's amazing to me that the stock just won't go down, right? If it goes down at all, it's almost like a safe haven now. When things get bad, they pile into it, and things are good, they pile into it. And so we'll see if that inverse head and shoulders plays out, because it did on NVIDIA, right? And so we're going to have to see, what do you guys think in the comments? Let me know. You risk on, you piling into crypto, you piling into high beta tech stocks, ARK and all the rest of them, or what? Because obviously big money or smart money has been piling in, but it's getting pretty high now. So when's that turn going to take place? That's kind of the key, right? And so, look at that. But then this week, this is a big week, right? Because now you get to see right there it is, March 22nd, Fed's decision on the interest rate. He's going to have his press conference. You'll see some huge moves right there. 24th, I'm not even worried about that, durable goods. 31st, personal income month over month, personal spending month over month, and then core PCE price index month over month. But, the only thing that matters is how much they're going to raise those rates. And what's crazy is, I don't know if you saw it, but the European Central Bank raised theirs by 50 basis points. I think it stunned a lot of people, because remember they were going through the banking stuff over there, and it was like, oh my God. They're like, we don't care. We're raising it. We're going to keep fighting inflation. And so the question is, what is our Fed going to do, right? Because they've already, I'm thinking in my mind, I'm thinking they're going to keep on doing what they're going to do, just because they're backing all the deposits at this point in time. That's what really matters the most. And so people shouldn't be all freaked out and go, oh my God, the money going under. There shouldn't be any bank runs, because they're backing them all. Forget 250K. Like I said, they're backing them all. No matter what's in there, supposedly, right? Banks are borrowing like crazy, right, from that window. Suppose they're not lending out that money. I'll be stunned if they're not lending out that money at a higher rate. Or the question is, are they going to tighten their standards even more and not lend out at all, right? And so that's a whole nother problem, because that takes liquidity out of the economy, which actually, believe it or not, it'll definitely slow it down. I think the Fed probably wants that. It'll probably help them in their fight. But again, if we start, if they do zero, man, the market's going to take off, which is great for short term. But what happened to inflation last time we had this rally? What happens? We talked about it. Inflation is going to stay around and keep going higher, or just stay between 5 and 6. That's what's going to happen. And for a lot of people, some people will love that, especially if you're a trader. This is great. Creates a lot of volatility in the market. That they'll just trade it all day long or whatever. And so, that's kind of where we're at on that. Let me know on the bottom what you think. It's going to be 0, 25, or 50. Okay, that's going to be the big question. That's all that matters this week. I mean, let's be real about that. So, we'll see what happens. But good to be back. I'll be back in the saddle every day and stuff. So, I hope you guys have a good one. Hit the like and subscribe button if you got anything out of it. And I'll see you tomorrow.